Hey traders, Steve here and welcome to Jackrabbit Trader. In this video we're going to do a portfolio review for Saturday, August 24th, 2019. If this is your first time here, first of all make sure you subscribe. Second of all, understand that you are receiving these videos if you're watching them on YouTube or anywhere else and you're not a member of the Jackrabbit Club. You're receiving these videos 30 to 45 days after they've been released to members. So if you want to unlock real-time updates, please make sure and subscribe down below using the link jackrabbittrader.com/membership and you'll unlock those real-time updates. With that said, let's take a look at the portfolio. So first thing I want to look at is obviously the market, right? We're always going to start by looking at the market, and this is my market cycles chart. And what we've done is every time that we're below the 21-day moving average, we consider ourselves to be in a red market cycle, and anytime that we're above the 21-day moving average, we're in a green market cycle. And we've been below a red market cycle really since the beginning of August. And if we look a little further, we had a couple pops above the 21-day moving average this past week, but ultimately we were always looking for that 294 level as resistance. So we couldn't break above that level and ultimately turned lower. So, we have some support down here at 282, right? The market, it's a tough market, let's be honest, right? I mean, one tweet, one piece of news comes out and all of a sudden the market, on Friday was down 70 points. And really until that point, you could have easily made the case that, hey, we're consolidating in the upper end of the range and maybe looking to break out over 294 to head back to the highs. Well, that kind of went away again on one single tweet. And, here we are, we're a couple points from the lows, and maybe, this sends us even lower. Who knows? So last week and what we talked about in this week's Jackrabbit report is the potential for this ABC pattern, right? So where you come from the highs to the low, back up to like what they call the throwback, right? And then it projects a price target below. So of course that lines up perfectly with the 273 level. And if you look at what happened back in May and June, this also pretty much marked the bottom as well. All right, so market likes to make these extended moves, really exhaust buyers, because what's happening, if you think about it from a trader perspective, is people are getting and they're starting to buy in this range, right? That's why we're seeing that consolidation here. Sellers are starting to come in at the 294, buyers at the 282. Well, what happens when 282 breaks? Well, all these people that bought using 282 as their stop, they're wrong, right? So now they're taking profits or taking the risk off the table, so they're selling, right? And then what happens? Well, these people that were using 294 as their risk tolerance, say they're short the market and anything over 294, they're now making money. And what has to happen when short sellers turn around and want to close their positions? Well, they have to buy. Well, where are you buying? Well, again, if you zoom out, you got to use the levels on the chart, and this 274, 273 area seems like a pretty good target to me. So in my case, this would be where I would be looking to take if I was ultimately short the market, which I'm not. Then we'd be looking to take some profits here, and that's what we're gonna, we use that level, we kind of carry it forward as we trade around the SPY with our hedge positions and everything like that. So, again, just understand it. It's a prediction, it's a 100% prediction that it may happen, but understand that it can happen, and it's a level that you need to be aware of. All right, so now that we've looked at it from a market cycle and a daily perspective, let's just take a look at the weekly chart. And again, this is the same daily chart just without the market cycles, and maybe you could see it a little bit clearer that this is that 282 level, and then here we are at 273, 272, and then really, I mean, you can kind of play this game all day. If we get past that, then maybe it's a 263. Then do we head back to 234? Again, I have no idea, but just understand that there are levels and you have to be aware of them. So Until we break 282, I'm still considering us to be in this range. But this type of move on a Friday afternoon in the summer, I don't know. You got to think about it that way too. So let's take a look at it from a weekly perspective, and we'll actually just clear this set real quick, and we don't need any type of trades on. So the last few weeks we've talked about how we're putting in these bottoming tails right here on the weekly chart, right? 1 and 2, and it would pretty much be a complete violation of, if you were buying against those longs or against those levels, if you break those levels, you're going to see, I think, a pretty quick move down. And you could see that same 273 level right in here, right, on the weekly chart. All right. But one thing I want you to see here is this little uptrend that was in play is now broke. Okay, so it was being held the last 2 weeks with these moves higher, and now this week we broke below it. So this is not, I don't consider this to be a bearish engulfing because it's not above and below the lows from last week, similar to how this green bar, all right, so it started below it, ended above it, and basically eats the previous bar, okay? So I don't consider that here. I just look at this as another level of consolidation because, again, we're in the range from 2 weeks ago, all right? So this week here, it basically established the highs at 293 and the lows at 281, 282. And until we break that, then we're pretty much in that range. But, look at the market from way back. We've had a good run, and now it's starting to get a little bit of a choppier pattern here, all right? And the other thing a reason I want to bring you up with this is there's also another pattern that predicts certain things, and that's called a head and shoulders pattern. Let's clear this real quick. And again, these are just complete predictions, but I think it's a good point or a good time to illustrate them. So a head and shoulders pattern is basically a left shoulder, a right shoulder. A left shoulder, a head, and then a right shoulder. All right, that still hasn't formed. So it's very possible that we get a move that we come down. Let's see how we're going to draw this. Cancel right extension. All right, that we come down, back up, and then we ultimately break down. All right, so it could be that we're starting to put that type of pattern in play. Again, that's probably maybe 6 months down the line if we're really looking at that. Thinking that we're looking at weekly charts here. But again, this may be something that we have to be aware of because we're starting to get this little bit of a pattern here where we're starting to broaden out. Okay, and I want you to understand that when this happens, all right, something has to give at some point. So we've broken this level, and I'm not doing this to scare you. I'm just want you to understand that we've been in most of the year a pretty good market. But understand that now as we start to move higher, we hit these levels. Now we've broken this. Now do we end up in a long story, in a period of maybe in the next year or two, do we end up going back to the 220 level? All right. Again, it's a broadening pattern. It's a bearish pattern. It's not good. So there's a lot of little things that are starting to come up technically that I'm watching that I think we need to be aware of. But as far as we go every day, we're not predicting the market. We're just managing our risk, managing our expectations. We're using those market cycles and making sure that we're somewhat in sync with the market. And I think that shows if you go ahead and you look at our portfolio. All right, I've changed everything to completely bearish again. So we were slightly bearish last week. Now we're going to be 100% bearish. And you can see that, over the last several weeks, we've basically traded in a range, okay, while the market's pulled back. And that's exactly what you want to be doing when the market's pulling back. I mean, I would love to say that we could make more money in every single market environment. That's not the case. I wish I could. So for me, in a bearish market environment, I want to just hold my portfolio as close to the highs as I possibly can, and then look to really capitalize when it's moving higher. Okay, that's the way we trade. That's the way that I've developed my trading process. If you want to develop it where you can make money moving when the market's moving lower, that's fine as well. But you could see that, here on the 26th, the market was up 21.9% for the year, and now it's up about 15%. So in a matter of a month, it's lost 6 or 7% on the portfolio, where in our case we've lost about 1.5%, not even. Okay, so understand that that's really what we want to do. And again, this week we kept it really simple, really focused on what exactly we were trying to do, and we knew that the market was in a red market cycle, so we didn't put any risk on last week. And let's head on over real quick to what we were looking at. Let's see. So when I sent the alert out on, I think it was Monday, the market had come up to these highs, right? So think about where we were last week. We came up to the highs, and I said, we're looking at maybe a potential reversal from these highs. I don't know if we can blow through them. But again, it's a risk. So we're looking for some way to define our risk. And the market came up, put in this little doji candle where it's basically indecisive. You have a high, you have a low, and you pretty much close right at those highs, or I'm sorry, right at the open. And then the following day we broke down under the 291 level, and I said, you know what, I think this is a good opportunity to maybe get short, hedge the portfolio again, because we could come back down and see the 282. So in an ideal world we would have seen that the next day, but it really tested us. We moved sideways and even higher at some points, and we were up at 294. But the key here is that we had our risk defined, right? So the risk was defined, and my risk is always on a closing basis. So at one point we were over 293 on Thursday, and it really wasn't until like the last hour of the day that we started moving lower and still closed below that 293 level. All right, so the trade stayed on. Even on Friday, it looked like maybe we were starting to head higher again, and then sure enough, we got lucky. Tweet came out, and boom, we went, we took the market lower. And if we look at the portfolio, that trade, I broke it up into 2 trades, and again, I sent that alert out that early on Friday morning saying I was taking half. Well, here is the half that I took. Okay, so I made 250 on that half. And then I also said that probably by the end of the day, we were looking for a move lower. I would be out of the complete position, and sure enough, I am, and that is right here. So, again, made $720 on just that one hedge play. More than makes up for some of the losers that we have to take today, and we're going to go over those now. But understand that, I could have easily sit here and say, hey, you know what, I didn't get out at the right time. I mistimed it. At the end of the day, I made money. I made $720. There's a lot of other ways that you can make $720. I don't know if you could do it in a day, but I'm sure there are people that do that. I sure as hell don't make $720 in a day at my full-time job. So $720 in my pocket is a nice way to finish out the week. And now we just go about managing our risk, right? So let's look at our portfolio and let's see what we have to do. And this is the process, right? I mean, we trade around the SPY, and we hedge where we need to. We try and go long where we need to, and we just let some positions work. And when they don't work, we kick them out and we raise some more cash. So that's what we're going to do right now. So let's go over to that weekly chart. Here we go. All right, so again, there's the SPY on the weekly. And we have no weekly trades. That's all old setups. We don't need any of that. All right, so here we are. First one is Adobe. It looks like Adobe has earnings coming up on the 17th of September. All right, so we got a while for that. All right, so Adobe, let's zoom this into actually. Let's go to a 3-year. There we go. All right, so here we go. Adobe broke out. Put trades back up. Broke out. All right, now closed lower, and really signaled that reversal here in the beginning of August, and then now has just really been slowly making its way lower and lower. Again, I like the idea that it stayed over 283, but 271 is my stop. So for now. Really nothing to do in Adobe, but not too crazy about this pattern, considering that we're breaking the uptrend line, we're breaking this 283, but my risk was always defined at 271, and that's where it's going to stay. ADP, all right, ADP at one point this week was looking good, right? We were up actually on the position, and we started maybe making a move out of this consolidation. That didn't happen. I've moved my stop up to the 162 level from 155, so we're really limiting risk here. Anything below 162, and I'm going to take an exit on that trade. Just not working, not the right environment for that trade. AME, right? This is actually an industrial. So again, similar situation. Had the breakout very shortly after, rolled over, put in these two bottoming candles here on the weekly. Okay, open candles with some significant downside extension, and here we are this week. Really didn't do much except pretty much negate what I thought maybe was going to be a short-term bottom. The 81 level is my stop, and I'll continue to use that. Comcast, just a complete mess, right? Look at the size of these bars in each and every direction, and here we came down, tested the 41, bounced above it. Now we're have a little bit of a topping tail here, closed at the lows. All right, so until we break below 41 on Comcast, I'll stay long. But again, none of these are really looking too great. The point of why we hedge is because I want to be in these positions. Whereas if the market, say now next week the market's up 150 points, let's say, and it completely forgets about Friday, and all of a sudden we break out, well, I can't adjust quickly enough in my portfolio to capitalize on that, right? We can add some SPY put or calls if that happens, but I can't adjust, based on a weekly process, right? So that's why I really like to keep these on as long as I possibly can, and just use the SPY as some protection. So Hilton, the one thing with Hilton that I will say is it's very organized, I guess you can call it. I don't know why these are like this. Let's see something. These are very hard to see. Edit properties. Let's even make them a 2 width. There we go. Right? So it's almost, like it's very organized in its pullback. And I'm not sure if that's a good thing, a bad thing, but it's just something to take note of. It's not all over the place like everything else. But until we break below 88, then we're going to stay long Hilton here. Honeywell. All right, Honeywell, it's time to go. I know that for a fact. And you can see we've toyed around with these closes below the 164 level. And sure enough, this week, ultimately couldn't come back. We're down almost $1,000 across all my accounts for my portfolio and what we follow. And I have to figure out, I guess, a better way to do this. But let's see, Honeywell, we're down $801. All right, so we're going to take the loss on Honeywell. And basically to do that, we're long 49 shares. So we're going to put 49 shares and we're going to sell at the market. And we're going to do a distribution, and we're just going to make sure that Jack is selling 14 and Ryan 7, 13 and 6 and 9. All right, so then we're going to send that order, and you can see selling 49 shares at the market across 5 accounts, and that'll sell at the market on Monday morning. RTN, all right, similar to Honeywell. This one actually held up a little bit better. And again, earlier in the week, you would think, hey, things maybe are starting to turn around here. But we're still in that range in RTN, Raytheon. And until we get below 173, then I'm going to stay long that name. Tractor Supply, this one looked great at the get-go, right? We had the breakout, a little bit of a pullback, and then sure enough, held the breakout level, started rallying higher, and then just straight down. So, my luck, and as I'm sure it is yours, we'll see a move back over like 103 this week. Signaling a potential pullback, right? 1, 2, 3, and then we can look to get back in it if that's the case. If everything realigns and we trade back over 103, which basically puts this as the low, the market cycle turns green, then you know what? We're looking at putting some risk on. Maybe Tractor Supply fits the bill. All right, but for now, it's not working for us. It's time to go. We're going to sell it at the market. And again, we're going to distribute that across all the accounts and just double check. 17, 8. Oh, that should be 15. And that should be 8 and 11. All right, so selling 59 across 5 accounts, and that matches up. And last but not least, UMP. Again, we had moved the stop up to the 164 level. It was holding that, as it started to round out. Not anymore. So it's time for it to go. And we're going to sell 36. Sell market. And again, apply that across all the accounts and just double check. So this should be 11, 5, 9, 4, 7. And again, you'll see that it changed it to now buying. So just make your last one a negative number and it'll change it back to selling. So selling 36, again, across 5 accounts at the market at the 160 level. So we're going to take those losses, right? And, let's see what that, you could look at real quick what that does to our little chart here. So this is going to be 8. What is Monday? 25, 26, 27, 8, 27, 19. And then we're going to obviously leave them open, but 8, 27, 19. What was the other one? TSCO 8, 27, 19. All right, and now they're closed. Then they do that. And, in the grand scheme of things, does it look that bad, right? No. It sucks that, we are now back to where we were maybe 10 trades ago. Not even. We're back to where we were 5 trades ago. But that's the point. That's the point, right? So we're taking taking that risk off the table. We're positioning ourselves better. We're not letting a loser turn into a giant loser like I did here with this hedge that I had completely screwed up on, right? These are the ones that hurt, all right? These are the ones that when you go from a $12,000 gain on the year to a $10,000 gain, those hurt. But this one, it's a couple losers, 15,000 down to 13,000. It's the same $2,000, but it's following my process. So I'm much more accepting of those losses. Those are losses that, I took my shot, I didn't get it. And, here we are. So up after those losers, and maybe, who knows, maybe we get a nice pop Monday morning and get a little bit of a better price. But taking those losers off the table, as of right now, results in a $2,000 loss on the account and brings us back down to $13,000 in profit for the year. So any questions or comments, let me know in the comment section. Let me know, shoot me an email, tweet, whatever you want to do. Again, if you enjoyed the video and you haven't subscribed yet, please make sure you subscribe and hit that like button and ring the notification bell. So other than that, have a great rest of the weekend, and we'll talk to you next time. Take care, guys.